Hello and happy new year. Welcome to 5 things investors need to know for the month of January. Of course, there's going to be change ahead in 2025. So today we're going to talk about what that might mean for you and your money. And I just want to start off with a quick look at where the markets and the economy are now. So if you're thinking about it in terms of asset classes or even sectors, the sectors that have started off the year strongest, just right out of the gate, are going to be areas like technology, financials, consumer discretionary, and then energy. Whereas areas like real estate, consumer staples, healthcare, those have all been a bit weaker. Now, we do expect some sector rotation to come again in the months ahead. And anytime we have a question mark about policy change, it's always a good idea to check your seatbelt for some possible volatility ahead. We're going to talk more about what's behind the volatility that we're seeing right now in a moment. But on the more conservative bond side, US corporate spreads are tight. So that just really means that investors aren't being paid much for the added risk that they're taking when they're investing in corporate bonds. And then if you look at longer term bonds, those have also struggled as well because we've seen uncertainty about the future of interest rate policy, inflation, and more specifically, long term economic concerns. But for now, economic fundamentals are generally solid, which is good news when there are changes expected ahead. So, next, just know that we're definitely facing some uncertainty this year, which is one reason we can expect more volatility. Now, this chart shows the spikes in uncertainty around unexpected events such as 9/11 and the 2020 pandemic, but it also shows higher levels of uncertainty around times of political change, like the upcoming inauguration, maybe for instance. But it's showing specifically Brexit, it's showing the 2016 US presidential election. And when the economy has solid fundamentals, as we're seeing now, it's really unlikely that uncertainty is going to turn into prolonged downturns. Just because markets may be volatile, that doesn't necessarily raise red flags at the moment. Still, though, we're just going to advise investors to always evaluate their personal risk appetite and invest accordingly because anything could happen at any time. And it's always important to be prepared for better than expected outcomes, but also worse than expected outcomes as well. Third, this is going to bring us to ways to be prepared for bumps. And really, I just want you to understand the reasons behind uncertainty. So there's two main categories of uncertainty. There's risk and then there's ambiguity. And we see ambiguity in a number of areas right now. So first off, tariffs and the resulting impacts on prices, on things like inflation, potential trade retaliation. Those are the number one question mark areas that I have for this year is what's going to happen with tariffs. Second, policy changes in Washington in general are likely to drive uncertainty as investors just try to predict outcomes. Third, inflation is also still a factor in 2025. We've seen a bit of reinflation recently. So, potential tax reform is another area that could make inflation harder to tame. And then finally, uncertainty is clear in the Federal Reserve because they're taking interest rate cuts on a meeting by meeting basis this year. And investors are projecting right now approximately only one future rate cut for 2025 at the moment. Whereas at last year's end, multiple cuts were expected by investors for 2025. So that's a big change. Fourth, another important way to be prepared for uncertainty is to understand that there are always winners and losers in times of volatility. And sometimes that goes against trends. And this is true of individual stocks and asset classes. So, just to give you an example, this chart is going to show you that small and mid cap stocks, so small and mid-sized businesses, have decoupled from large cap stocks, but generally they're trading below their long-term average valuation. So this, in layman's terms, just means that they're not moving with the market, but their prices are still relatively attractive. So small caps haven't been as profitable in recent years, and this is an area I'm watching for potential opportunities. But just keep in mind that over 99% of businesses in the United States are considered small, and these small businesses represent nearly half of private sector jobs. So, of course, factors like inflation and tariffs have big effects on small business. And we're just going to keep watching small caps and the state of the small business market this year. A final note on volatility and uncertainty. Passive investors who have stayed the course all the way back to 2009 through now have really enjoyed record gains and outperformance of their investment portfolios, as you can see in these two graphs here. Now, passive investing has worked since major indexes have largely been positive. And if you're not familiar with passive investing, that just means that you're buying a basket of companies or a basket of bonds, whatever it is you're buying a basket. So you're really spreading your risk out. Okay. But analysts are now questioning whether this outperformance can continue and whether active stock picking is going to resume favor. Actively managed portfolios allow managers to respond to changes and also identify the category winners and lose in ways that passive funds don't. And at EverThrive, we're proactively making portfolio adjustments for our actively managed clients based on their risk tolerance and also their time horizon for investing, because we want to account for uncertainty and hopefully take advantage of new potential opportunities. Well, that's it for this month. Thank you again for watching. Happy New Year, and we will see you in the month of February.